It doesn't require knowing super complex concepts. You only use one time frame and can be any time frame. You should probably know where you perform your best. The first important factor when you open your charts is understanding the recent trend on that specific time frame. I usually mark the direction of the market with the swing points. It makes it even more obvious that in this specific case we had a downtrend. But what actually matters the most is knowing what even is a downtrend. To be more specific, the structural fundamentals of the downtrend. The downtrend is simply just a market where the push to the downside is larger than the push to the upside. The downtrend is basically that movement repeated over and over again, exactly like we see on the chart. Now, this translated into actual market structure concepts would say that the downtrend has constant or repeated lower highs that are then followed with lower lows. The key is in the repetition of this pattern, because we can notice how after the lower low has been set, the market pulls back to the upside, so it pushes higher. But this upwards push ends below the last high, so it forms a lower high once again. Then right after, the market pushes to the downside, which eventually forms another lower low. And this goes on, repeated constantly, which is what is called downtrend continuation. The logical setups on downtrends are sell setups. It doesn't make sense buying a market that you see constantly going down, and the place it makes the most sense to position sell setups are as close as possible to the last lower highs. Of course, this placement is done from a so-called supply zone, or resistance, which is the last upwards candle before the market started to gain bearish pressure, which on the highest point of this chart is right about this level. We will often see how the next high coming from a pullback to the upside will probably end inside this level, from where we look to sell the market down. But in this specific case, that pullback to the upside ended with the next high not being able to hit the supply. Keep in mind that not all of these supply zones will fill, nor will respect, and we don't even need many of them, so as long as the downtrend keeps holding, the opportunities will eventually appear. But of course, we need to know how to capitalize on them. For example, after the next high that was then followed with a break of the past low. A similar bearish pattern happened, essentially a lower high with a lower low formation. And again, the same theory applies. The supply or resistance is found on the lower high, and more specific on the last upside candle before it started pushing down. And in this case, we can easily spot how the market hit the supply with the next pullback to the upside. And this time, if we place the sell setup from the bottom of the supply, stop loss above the supply, and take profit below the low, in such a way to have around a 1-to-2 ratio, or slightly higher. The market then starts pulling back up again. Then it continues the bearish trend by breaking the last low. This confirms a lower high coupled with a lower low, so it kept the downtrend pattern. Now again, we look for a supply on the last lower high, should be around this level. And we enter with a sell short setup on the supply, exactly like before. Entry on the bottom of the supply. Stop loss above it, take profit below the previous low, but low enough to get at least 1-to-2 ratio, or slightly higher, but not by a lot. The pullback looks to be sitting on the supply right now, so the position opened. But this time it turned into a loss, which shouldn't be a big concern if you actually start analyzing what just happened, and we look for another opportunity. For example, you don't just look at the result, but we look at what caused it. And that happened because the market broke above the previous lower high, so a broken lower high becomes a new higher high. And a higher high is a structural pattern of an uptrend. That means that the downtrend has shifted or changed into an uptrend after the market broke above the last high. And on uptrends, after higher highs have been set, a higher low should be coming up. We just don't know where that higher low will end. It could end here, or here, or here, or maybe even here. We can't know with such accuracy. But what we can know is that if we expect a higher low, that means that it needs to end above the last low. So in other words, it should not break below this level. Because if it does, the higher low invalidates, and it actually forms a lower low since it would be a break below the last low. If this gets to actually happen, then the likelihood is that the uptrend invalidates and the downtrend begins once again, where we will probably see some lower high and lower low formations. But we don't try to predict the reversal, and instead we trade along the trend. In this case, if we have a higher high, we expect a higher low as the next swing point to the downside. This higher low should end on a demand or support, level that's taken from the last push to the downside, right before the market started the upside pressure, which would be around this candle. Now the problem with this demand is that it's quite big, and the bounce could happen from any level, so we don't have a good entry level. There is an option or solution for this kind of problem. We can refine this large demand into a smaller one. So we apply the same theory of the demand being the last bearish impulse before the upside impulse, but we do it on the last price action, internally. And if we look at it, this is very simple to spot. And now on demand zones, instead of selling them, we position buy setups on the top of the demand, with the stop loss below the last swing low. Be careful and pay attention, because placing the stop loss below the recent internal low, so around here, this doesn't make sense, because the market can break this down and still hold an uptrend. Because keep in mind that the uptrend is held as long as the market does not break below the swing low. So it makes more sense to have the stop loss below the swing low rather than below the internal low. And for the take profit, as we did on the last ones, around a 2.5 ratio would be fine. So we need to see if we break the past lower highs what risk reward we're getting. Here we're not even getting 1 to 2, so we might look to target a higher level. The next one is this swing high, and now we're getting to it. I would go slightly below so we keep the consistency at the 2.5 risk reward, and now we pretty much just need patience, set alerts when the market hits the demand, and then we'll see how it reacts from it. So far the market pulled back down, which we did expect, and now it's consolidating right above the demand. Here finally the price hits into the demand, which opens the buy position, and eventually closing on the take profit. Now the reason you want to be careful of the exit target is that there might be sell entry structures that might push the market down. For example, in this market we just had to zoom out a little and we can already see the supply on the highest point, which is the supply that did not fill at first, the one that we saw at the very beginning. And it looks like the market is right now testing this supply, so if you would have targeted for a take profit above this high, the risk would have increased by a lot because there is a good enough probability we might see a rejection down from this supply. Let's try another one. So when starting fresh, basically just got into the charts, we begin with a directional analysis of the market, exactly like we did on the last one. And what we care about the most are the swing points the market is forming. In this specific scenario, the market looks to be forming a downtrend pattern. The downtrend, as we saw on the previous chart, is a market constantly breaking the last low. When that low breaks down, it creates what we call a break of structure to the bearish side. After the bearish break of structure, the market will probably start and print once again a similar pattern. Usually after a break, the market pulls back to the upside, and you will notice many times that this pullback will hit a supply formed from the last lower high. But in this case, similar to what happened on the last market, the pullback ended below the supply, so it did not fill the supply. Which, as I said before, that shouldn't be a problem. Don't worry about missing setups or even losing. The theory does not always apply because if it did, trading would be far easier than it seems. But we all know that's not the case. So let's get back into analyzing this chart. After that pullback, the market followed with a bearish push that eventually broke the last swing low. So a very similar pattern like we had before, where we had a pullback to the upside, which was then followed with a downside push that broke the last low. That's what also happened recently. Now after a bearish break, we should be expecting some kind of upside pullback. The question is, where should this pullback end? Well, if we look at the swing points we had until now, we had a lower high, a lower low, another lower high, another lower low. So if we trade based on the trend the market is following, with the same swing point patterns, we should be expecting a lower high. That means that the market should not break above the last high, but the pullback needs to end below this high. Else if we break to the upside, that's a trend reversal. So the downtrend would invalidate in that case. But until that happens, we keep a bearish bias. So if we apply the theory of bearish continuation, and we expect a lower high, that lower high should often end on a supply. The supply is formed from the last bullish candle before the bearish impulse, which would be around this level on the new lower high structure that was formed recently, but this supply kind of already got filled here. We can still use it on a potential next pullback and sell from here into a lower low. Or we can wait for the market to create new opportunities, in which case, we wait to see what the market does and we take action only after. For example, what happened shortly after is that we got another pullback to the upside that was then followed with a break of the last low, so again, a formation of a lower high coupled with a lower low, and similar as before, this new lower high might have rejected from a supply formed from the previous lower high, this supply pushing the market down into a lower low. Now after a lower low, we expect again a pullback to the upside, so it can create the lower high. That high ends up being a lower high because the pullback rejects back down from a supply, the supply being the last bullish candle before the market started pushing down into breaking the last low, this one being the supply, and again positioning a sell short setup on the bottom of the supply, stop loss above it, take profit below the low at around 2.5 ratio. It pulled back into the supply opening the sell position. Now it's slowly going down. But the bullish pressure came back in and eventually stopping the position out on a losing setup, and as I said, that shouldn't be a problem. Losing is completely normal and expected. What matters is losing as little as possible, because if we analyze the market's trend, what changed and why this happened, we see that after this lower low, the market pulled to the upside and formed a lower high, which was what we were expecting. But after that, instead of continuing with a lower low, the market held the next low into forming a higher low, which was coupled with a higher high. These are swing formations of an uptrend, so the market reversed its trend from a downtrend into an uptrend. And on uptrends after a higher high, we expect a higher low, so essentially a pullback to the downside. But this pullback needs to end above the last low so it can then continue the uptrend. We can catch that higher low from a demand zone. The demand is found on the last bearish candle before the market started the impulse to the upside. This one being the demand in this case, and we position a buy setup from the demand. Stop loss below the low of this demand, because if the market would break below this low, then we would reverse once again into a downtrend. So as long as the market stays above the last low, it's holding an uptrend. Now for the take profit, I would look to target around a 2.5 risk-reward ratio. Might even go for a 1 to 3, but rarely above. That's the most I would suggest in targeting. The pullback to the downside is quite aggressive this time. The position opens from the hit of the demand, the market bouncing right away into hitting the take profit target. Now structurally, we will probably see more upside pressure, since the market is on an uptrend, and on uptrends we must have formations of swing higher highs. So basically, that's most of what we need for this strategy to understand how the market forms the swing points. If we know that, then we also know the trend. And if we know the trend, we can position setups more towards that trend. Now you might also apply the concepts I have on my program. You can find them on the description of this video. But for now, we'll see you on the next video.